Hey guys, and welcome back to another episode. It's me, Adam, and you're watching Unlimited Options Investing. In this video, we're actually going to be taking a look at the Compound and Friends. On this episode, they had Nick Maggiulli, I'm definitely not saying that correctly, as a guest on this episode, and having the age-long debate of whether it's better to average into your investments for the long term, or if you should just take a lump sum of money that you have and just throw it all into the market and just pray that you made the right decision. It's a pretty interesting video. I've had this debate before in the past with some friends, and we haven't really come to any kind of agreement. But this 15-minute conversation that these guys have does shine a lot of light on which one is better. So right before we get into the video, if this is your first time on the channel, welcome aboard and hit that subscribe button, smash that like button, and take a look at the description for my Instagram, my TikTok, and my Twitter. Check it out.
Okay. I wanted to go into dollar cost averaging versus lump sum. Nick, this is probably the area of your research and writing that people are most familiar with. Some of your biggest dropped bombs come from these topics. First of all, why do you think, not that you're controversial, but why do you think there's such a raging controversy about whether or not people should drop a lump sum into the stock market versus dollar cost average over a longer period of time? Why does that get people so worked up?
I think it gets people worked up because I'm saying like, hey, look, the evidence shows this is generally the right move. However, the problem, there's a lot of risk.
What's the
risk
right?
in doing
What's the right?
the right? I'm sorry. The right move is
move?
to lump sum, right? To buy sooner. And I think so. In the book, I talk about this in chapter 13. I discuss this. I don't call it dollar cost averaging and lump sum. I think the issue is dollar cost averaging technically has two definitions. The original definition that Ben Graham used was like just buying over time. So when you're buying your 401k, you're dollar cost averaging. What this is doing in this example that we want to throw charts up and all that, this version of dollar cost averaging is like you have $100,000 because you sold a business or you got an inheritance, and do you put it in right now or do you slowly what I call average into the market, like waiting?
Well, it depends on what the Fed is doing.
Yeah. Okay. Well, point is generally the main premise here is the only thing that matters is you generally want to invest sooner. So like whatever it is you're doing, just the sooner the better. So that's the main takeaway. So it doesn't matter what terms used. In this case, lump sum is investing right away. It's sooner, right? And I think the thought experiment that does this, I said, let's say you had $100,000, or let's say you had $100 million and you want to preserve as much purchasing power over the next century, right? Would you rather put $100 million invested today, or would you rather put $1 million a year for the next 100 years? Now you're saying, you think about that and you're like, yeah, that makes no sense. Inflation is going to destroy me. I would easily put all the money in today. Well, if you wouldn't wait 100 years, and you shouldn't wait 100 months or 100 days even. Right?
Point taken, but I think I don't know if I disagree, but you are sort of robotic in your personality. I think there's something to be said about the psychological comfort of not putting a lump sum in and having to like just have the anxiety of holy shit, what did I just do? So I think that there is a limit of time that makes sense. You don't want a dollar cost average a lump sum over a 5-year period. That's idiotic. But if you want to give yourself a year, even 2 years to psychological, especially if it's an inheritance where there is a big emotional component attachment to that money, I can get behind dollar cost averaging, even though quantifiably it is undeniably the wrong decision.
Yeah. So the question.
So there is something absolutely to be said about the psychological component of investing and being able to sleep peacefully at night. This brings me back to in 2020 when I first started learning about stocks and creating long-term wealth, slowly but surely. Things like fundamentals of companies and having conviction in them and owning them as businesses, not just as ticker symbols. To block out all the noise, stay invested, and that there's actually less risk as stocks are falling because that means there's more potential reward moving forward. All these principles of investing remain true today and have been true for centuries and will likely continue remaining true.
Is if you're willing, so on average that's about like over a year. Let's say you did 100% stocks, you're probably not going to be doing that, but let's say you did 100% stocks, I lump sum, you dollar cost average, on average you're going to underperform by 5%. So if you're willing to give up, like if you're willing to pay
which is meaningful.
Yeah, I'm saying if you're willing to pay a 5% premium on average to do this for this peace of mind, do it. I don't care.
Right.
I'm just telling you that's what the data shows. So on average that's what's going to happen.
Well,
the problem
the problem is that people feel that there's got to be some brain power involved. And most of them will say, okay, that's probably true, but look at the valuation of the market. And so it's not going to be true this time.
Well, yeah.
That's the thing that smart people are always going to come back at you with.
Oh, that's definitely true.
Yeah.
Again, block out the noise. Macroeconomics are almost impossible to predict. Market timing, true bottoms, highs, lows, also impossible. Hindsight is 2020.
But here's my counter to you guys even. You're saying, okay, well, I'm going to average in over the next 12 months. Okay. The only time when that average in method beats buying now is in a falling market.
When you're-
and
when
that's
you're
the
gonna
time
stop.
when
When
you're
you're gonna
least
stop. Right,
likely, you're going to be least enthusiastic. So
100%.
I'm not going to cede this point because of behavior. Well, my behavior, yeah, it's going to start crashing. Like imagine crashing in March 2020 and then you're like, oh, I'm just going to wait for the dust settle. And then 6 months later, you're at a new all-time high and you just
But
lost on a
that is a great
100% annualized
that is a
return.
great counterpoint. But let's also stipulate that most of the time that doesn't happen.
Yeah, I know. And that's that because most of the time it doesn't happen, you should be lump summing. That's my point. Like you just proved my point. Like, oh my God.
So we have this chart. We have this chart that makes that point. It's dollar cost averaging performance over 24 months versus lump sum investment using the S&P 500 total return. And there are these two distinct periods where DCA is winning versus lump sum. And both of those are during stock market crashes. One of them starts right after the year 2000, and then the other one is 7 years later, starting at about
07, 08, yeah.
So those are the only two periods of time, and they're short, where the DCA line is above 0%, meaning it's outperforming. Most of the lifetime of this chart, lump sum, meaning you just invest it and let it fly, you did much better. And you actually quantify, on average, DCA underperforms lump sum by 8.8% over this
2-year period.
Over this period on rolling 24-month periods. So in 77.8% of all months shown, you were better off with a lump sum investment.
But are you really going to fight the Fed?
People have.
Are you really going to fight the Fed?
Wait, what is it? The
Yeah,
Fed?
yeah,
I thought the Fed's pumping up the market, so you should be
No,
doing lump sum,
hold on.
right?
We,
Are you
we
kidding?
haven't
Not
even
now,
discussed
they're
this. We haven't. It's been an hour and a half almost. We haven't even discussed the fact that the adage for the last 10 years has been don't fight the Fed. I mean, they've got your back. Literally, it's reverse. It's 95.
Now you can fight it. Now you can fight them.
Yeah, now you fight it. No, they are pulling back $95 billion a month of less liquidity in the markets. Is that going to matter? I think it mattered on the way up. I don't see how it doesn't matter in reverse, but we will see.
That's why when they point a gun at you, you charge. It's a knife. You run away.
What's that from?
You
My
charge at a
cousin
gun.
Vinny.
What's that
My
from?
If it's a
cousin
knife,
Vinny.
My cousin
you
Vinny?
run. No, it's
Oh
not.
no!
But it's
Al Pacino. So why am I thinking it's Al?
Irishman.
Is that from
It's
Heat?
Irishman. Oh, that's right. It's from
It's
Irishman.
Irishman.
Oh, because I got it confused. They're all in my head. Yeah.
Remember when?
Because they're in a
remember
courtroom
when,
too. They're in a courtroom too. That's why it's so
yeah.
confusing. Yeah.
So the guy tries to take a shot at
his
what's
son.
his
Yeah.
name? And his son comes and charges the gunman. He says, you charge at a gun. It's a knife. You run.
Yeah.
Right.
It was
now you
Irishman,
can fight the
yeah.
Fed. What is this table? Bitcoin DCA. What are we doing here? Are we taking psilocybin mushrooms?
I'm just saying, even in I'm saying in every single asset, this is true. Like I have not found an asset where if you had just averaged in, it would have been better than just putting all the money in right away. Because guess what?
true?
Most assets go up to the right. Yeah.
Now, this is a bit surprising to me as crypto is so much more volatile than the equity markets, but just goes to show most of the time, timing when to put your money to work may not be the wisest decision.
That's the issue. Most assets
Okay.
go up into the right over the long term. So
Let me give people an idea of what that means. Dollar cost average in Bitcoin, this is obvious, would have been underperformed by 471% versus, and this is over 24-month rolling
Yeah.
periods.
yeah.
So, all right. I mean, that one's obvious, but
That's
even
kinda wild.
treasuries, you underperform by 4%.
471% for crypto. That's crazy. And although much less when it comes to stocks, still meaningful numbers at 7 and 9%.
Over 2 years,
If you
yeah.
dollar cost average over 2 years, gold 9% underperformance, international stocks 60-40 portfolio. So all right, so if you're going to invest, it pays to be invested early with as much money as possible, not on every month or every day or every year, but just generally speaking, put the money in the investment and shut up.
Yeah, and
That's
if
it.
you're worried about risk, maybe what you're investing in is too risky for you. That's my other counter. Like, there's a way of like, okay, why don't you lump sum into something that's a little bit less risky? Instead of going 100% stocks, maybe go 80-20 or something. I don't know. I'm just like trying to throw something out there.
All right, so now I have a bones pick with both of you guys.
Again, being able to sleep at night in the short term and peace of mind is worth something. Investing, for example, 80% into the market and having 20% cash for a rainy day, if the market does have a downturn, could be worthwhile. Perhaps not as well if you just threw in that lump sum and then over the long term, but it does give you some wiggle room if things do go south, but statistically much, much better than being underinvested.
Why won't you guys do my experiments for me? I don't have the skills to pull this off myself. I know there's something here. I just know that somebody has to want to spend a little bit of time and brain power on it.
You're asking to just how do we time the market?
No, it's better than that. What if we have a dollar cost average, not to beat lump sum, to beat traditional dollar cost average? This is my idea. Dollar cost average on steroids. Here's what we're going to do. And I don't know the numbers or the cadence, like the intervals, right? But just hear me out. I know for a fact, without the data, I religiously believe this. If we can come up with a way where we have a standard dollar cost average that within a range bound of the VIX just operates like any dollar cost average would, and then when the VIX gets above a certain level, I don't know if that's relative to where it was, like a moving average, or it's a number, we say 25, whatever. The dollar cost average amount doubles. We're putting in twice as much as we would in a standard period of time. And then when we get back below that threshold, to make up for the fact that we've done that, we have to cut back on how much we're putting in. So it's like a smart dollar cost average that is literally doing the opposite of what most humans would do if left to themselves. And it's actually adding even more investment during very volatile markets. I'm not saying the payoff of that is immediate. I'm just saying I know over 10 or 20 years, you are way better off investing more in the midst of the highest volatility readings.
Yeah,
why can't we do this?
Well, you can't do this because where's that extra money going to come from? It's just going to wave a wand.
I told you. No, I
double
told
your
you we're going
cash
to
in?
we're going to invest. We're going to invest less to make up for it when the volatility comes down.
Okay,
Until we get back to an
let's
equilibrium.
say you're investing $100 a month beforehand, and then volatility goes up, you double it to 200, and then after it comes down, you go back to 50 or something, or what's the?
I double it let's say I'm doing monthly DCA.
Yep.
I
okay.
double it every month during which the market is in that higher VIX
Okay.
level. Now, markets don't tend to stay at that elevated VIX level for very long. So you're not going to have to be doing these doublings for 9 months in a row. It's just not the VIX is an oscillator. It's not the nature of the thing. And we want to do this during extremes. We don't want to constantly be changing the DCA amount. I just feel like if you do this over 10 years or 20 years, you have to be coming out ahead.
Well, I think the question now is like, where do you get the cash, the extra cash? You're saying extra
don't worry
cash.
about it. I'll get you the money.
That's the prep.
I just want you to do the data.
I can tell you, this is like the buy the dip. I've done these analyses. I'm telling you, this will not work. I'm telling you're
Michael,
right.
Why
you're
won't
right,
this work?
Because you're sitting.
Tell him it'll work.
When the VIX is below a certain range, when you're going to be holding extra cash, waiting for the VIX to go up, and you're going to wait too long, and that's how you're going to lose out. That's how you lose.
That's going to be the tax.
Yeah,
on it?
you're like, if you can magically double your contributions while the VIX side, then yes, do it. But like,
dude, get a side hustle.
All right, so just run I'll get you the money. Just run the
I'm
number.
saying that makes no sense. How does the money just materialize? It just
Nick,
like
when the VIX spikes, you get a side hustle. Hello.
Okay, yes, then that's great.
When the VIX spikes, when the VIX spikes, the connection to your bank. Let's say you're doing this. We have liftoff as our robo. Liftoff. When the VIX, it triggers liftoff telling my bank, hey, put an extra 100% deposit into Josh's account this month. Let's say I'm putting in $500 a month.
Yeah.
Put in $1,000 this month because we're in our higher VIX regime. That might happen 2 or 3 months in a row. I can live with that. I have decided that I'm willing to do that as the investor.
I do that
so
manually.
Forget about where the money comes from. Let's say that's possible. Then what? Could I have something here?
Well, so you can't forget where the money comes from, because that arguably that money's been sitting in cash. You could have been investing it earlier. That's my argument. That extra 500. No, you're
I didn't
right.
earn it yet. I hadn't earned it yet. It was just money that's going into my bank for my paycheck. So if magically I had left that money accumulating in the bank and I had the ability to make a double deposit in a higher VIX regime automatically over time, you don't think my DCA on steroids is beating the shit out of regular DCA.
I agree. No, I agree that if you have the cash to
build it.
invest, you should do it during a during.
Do you know
one
how
of these
much
high
money
VIX
we're
regimes.
leaving on the sidelines? Do you have any idea?
Let's wrap.
What do you mean? Let's wrap.
Do we have another?
Wrap up my data set. All right. I want to do this. I want to do this crazy article real quick.
Interesting theory from Josh here. He has a point that when the VIX is high and fear is the dominant sentiment in the market, that buying more aggressively is actually a better thing to do. But as Nick says, if that money had been sitting in your bank account for a certain amount of time before the VIX began to spike, that same money could have been making you more money before the market began falling. Again, timing is impossible. Hindsight is 2020. Alright, and that concludes our video for today. Thank you very much for watching. As always, let me know in the comments below, are you the type to just throw a lump sum into the market, or do you dollar cost average? Let me know in the comments below. I hope this video brought to light which one is better between the two long-term statistically, but again, the emotional factor does play an important role. Thanks again for watching. Hit that subscribe button, smash the like button, and check out my description for my Instagram, my Twitter, and my TikTok. See you guys in the next video.